Are you struggling to find the right combination of technical analysis indicators to put together on your chart? Maybe you're using indicators and you don't even realize you've got the wrong combination put together, or maybe you've been losing money trading and it's because of the indicators that you have put together. Well, in this video I'm going to take you through the key rules that you need to know to become more profitable in your trading by applying them. I'm going to give you a quick 5-step process that you can follow to apply that structure around your trading, and then we're going to have a look at a few examples just to cement the theory in place. So let's get into it. So let's firstly define what the problem is. It's what is the best indicator combination to put together. How do you know that you are putting together the best combination? How many indicators should you be using? How do you actually go about putting, constructing this combination? And the $1 million question is, are there any rules that you need to follow to allow you to achieve the optimal selection and give you the maximum chance of trading success? And unfortunately, this is what I sometimes see. It's a total mess of a chart. Too many indicators, too much going on. Psychologically you can't just handle those indicators. You're going to talk yourself out of trades. You're going to put the wrong stop loss and target levels. There'll be so much indecision, and basically it's just not going to work. You've got to refine the process, make it systematic, and get it to work. It's a lot more simple than what you think. So my first rule, and it's very, very obvious, keep it simple. You don't actually need that amount of indicators on your chart to make a strategy work. Sometimes the best strategies are the simplest. So I'm hoping you're starting to see now that the importance of choosing the right combination of indicators. It's not just a case of picking what you fancy, the popular ones that you might read about or see about on YouTube. It's about understanding how they work together. And the wrong combination can give you conflicting signals, while the right combo can increase your confidence in your trades. Now the second rule, and this really is the crux of it, the most important part, is this rule called collinearity. What does that mean? It means that avoiding multi-collinearity amid indicators. Quite simply, that's multiple counting of the same information. For example, you might have 4 indicators on there based all off the closing price. Well, essentially they're all telling you the same thing. What you need to do is have 4 indicators that are mixing up the variables, all giving you the same answer. So maybe one of closing price, one of volatility, one of sentiment, one of something else. That combination, once you get 4 yeses to buy, is far more powerful than one that you think is working based off 4 of the same. Now I've put together a simple 5-step process to help you get this problem sorted. Now, step 1 is to identify the current market condition. Is it trending or range bound? So something like the DMI indicator is very good for that. Your choice of indicators will vary depending on this, and rule here, don't backfit the information. Don't make it work just by fixing those indicators. Have some logic to what you're putting together based around whether it might be a stock market trade, commodities, something in a illiquid market versus something in a liquid market. There's a lot of variables that go into selection, and the first step is identifying the current market conditions. Step 2 is picking indicators that provide different types of information. So for example, combining a trend indicator like moving averages with a momentum one like RSI, and that gives you a clearer, more comprehensive view of the market. Remember that rule of collinearity. Now step 3 is not just about sticking to the default settings. Optimize your indicators based on the asset you're trading and the time frame. Customization is key to precision, but the caveat here is don't backfit. I'll keep mentioning it. Don't backfit just to make it work. I like to test on a broad spectrum of markets, time frames, chart types to see whether my idea is working, more generically than just trying to fix it on one particular market. Customization is key, but you have to be careful with that. Do not backfit. And I've mentioned this a lot as well. Backtest. Step 4, backtest your indicator combination of historical data. For example, you can do that in TradingView if you like, the Pine Script code. I've got a video on that. I'll put a link to that video and how you can do that if you're not a coding expert at the end of this video. But backtesting, maybe you need to do it manually, just going through the chart, getting through the trades, seeing what works, or maybe going live with a small amount of capital, a lot smaller than what you would normally do, just to get some live data under, in your pocket, so you can analyze the results that you are getting. Backtesting, extremely important. Finally, step 5, remember that the market is a living beast. It's always changing. Keep monitoring your indicators' performance and adjust them as needed to stay ahead. Don't just adjust them after every trade. Again, have a systematic approach to that. Give your strategy, a month, 3 months of testing and see what works. But remember, your edge erodes over time, and you've got to stay one head of the game if you want to be a consistently profitable trader over the longer term. Now, I've put this table together to help you out a bit here. Now, on the table, just as a bit of housekeeping, CP means closing price. Now, the table, 5 different columns: trend, momentum, volume, volatility, sentiment. If I was putting together a combo of indicators, ultimate indicators, I would pick maybe one from the trend, one from momentum, or one from volatility. Look for 2+ indicators. You don't have to put everything, the kitchen sink in there. Pick maybe a sentiment one, a momentum and a trend one. The combination's up to you. Sentiment, volatility, volume, totally up to you. But as you can see, for example, you take the trend column, you might pick up moving averages, and from volatility you might use the Chaikin volatility indicator, because they're 2 different sources of calculation that are going to come up with an answer for you. And if they're both telling you the same thing, then you're more confident. The odds of you succeeding are more in your favor. Let's now look at some combo examples that cement the theory, the ideas that I've talked about so far in this video. So in this example, I'm using Nvidia on a daily chart. It's a stock market play that I'm looking at, and I've put probably more than enough indicators on here, but I just want to show you why I've added these ones on. So starting with my trend indicator, here's this light blue line you can see here. That's a 50 period moving average. Now I've also added a momentum indicator that's below the RSI down there. I've got a volume indicator here, the OBV, the on balance volume, and I've also added a volatility indicator, which you can just see there as well. That's the Bollinger Bands. Now you could also add a sentiment indicator like the put-call ratio if you can get hold of that data to give you a point of view on what the options traders are thinking around sentiment wise, bearish bullishness for Nvidia. But that is a combination. Now you don't need to add all of them. You might just have, say, the trend indicator, the 50-day moving average, with, say, maybe the momentum of the RSI and the volatility of the Bollinger Bands. In this example on Bitcoin, I've got 4-hour chart. I'm using a volatility indicator, the average true range, which you can see there. Why would I have that? Well, it measures market volatility and helps in setting stop loss levels based on current volatility. What else have I got? I've got the stochastic here, more for a momentum type play. Settings in this example 1433. It's going to help identify momentum shifts, especially useful in volatile market conditions. And you also see I've got this Ichimoku cloud, only the cloud on here, and this is my trend indicator above the cloud, bullish, below, bearish. You know, I could have also added on maybe a sentiment indicator like the fear and greed index for Bitcoin as further confirmation. So another example there with a different market on a different time frame. So my final example, got the euro US dollar currency pair on the 1 hour chart. What indicators am I using? Well, I've got the light blue 200 period moving average here, you know, above bullish, below bearish, so a trend filter. Then I've got a momentum indicator at the bottom there with the MACD, and I've got a volatility indicator. You see those blue lines there? That is the Keltner channel. Now again, I'm looking for them all to confirm to start to build up my trading strategy for either buy, sells, or stay out. I hope you found the video useful and that you can apply some of the theory here back into your own trading to make your technical analysis charts much more successful. We've looked at the problems, the theory, giving you the rule of collinearity in a 5-step process and some examples to help cement the ideas, and like I said, that you can use in your own trading. Really getting this right at the early stages is very important for your strategy design, application, optimization, and success in the longer term. So like I said, if you've liked the video, please give us the thumbs up. It all helps the channel. Don't forget to hit the subscribe and bell notification buttons to get future content or any new content that I'm producing for that matter, as and when it comes in. Also a playlist at the end of this video that you can work your way through, the ultimate trading course playlist, free here on YouTube. Work your way from the top to the bottom, and hopefully you'll come out a better trader for it. And also that video I mentioned earlier about automating your trading in PineScript and TradingView, they're all coming up now.